Okay, good morning everyone. Welcome to the Financial Stability Report press conference. On my far right is John Cunliffe, the Deputy Governor for Financial Stability. On my left is Sam Woods, the Deputy Governor for Prudential Regulation. And on my immediate right is the Governor, Mark Carney.
Thank you, Gareth. Good morning, everyone. The FPC is responsible for identifying risks to financial stability and for taking action to ensure that the UK financial system can serve UK households and businesses in bad times as well as good. In this quarter, these responsibilities have taken the committee from capital to credit and to cyber. The FPC views the risk from the global environment as material and having increased in recent months. In particular, developments in Italy underscore the vulnerabilities created by high levels of public debt and the interlinkages between banks and sovereigns in a currency union. Tightening credit conditions in US dollar funding markets are creating headwinds to growth and increasing risks in some emerging markets. In addition, debt levels in China remain highly elevated while the rebalancing of that economy is still underway. Trade tensions have intensified. All of these conditions could crystallize the long-standing risks of a snapback in interest rates and a tightening in global financial conditions with negative spillovers to the United Kingdom. Domestically, the FPC continues to judge that, apart from those risks related to Brexit, risks remain standard overall. In other words, most financial stability indicators are neither elevated nor subdued. Levels of household and corporate debt relative to incomes remain materially below their pre-crisis levels. Growth in overall credit remains broadly in line with that of nominal GDP. In addition, the debt service burdens of households and businesses are low, and it would take a sharp increase in UK interest rates without any corresponding rise in incomes to bring them back to historic averages. Since the committee met in March, the cost of bond finance for both UK corporates and banks have risen. In the housing market, although UK lenders have increased spreads on mortgages, overall mortgage costs remain low. But weak demand has meant only modest mortgage credit growth, and the FPC's mortgage market measures continue to ensure against any reduction in underwriting standards. Consumer credit growth has decelerated in recent months, though it is still expanding faster than nominal GDP. The committee has acted to ensure lenders are able to absorb severe losses on consumer credit, and there are signs of reduced availability on domestic credit. Although non-bank lending to riskier companies has been expanding rapidly, lending by banks to such highly levered firms has been muted, limiting the increase in overall corporate leverage and containing the risks to the financial system. So in this standard risk environment, the FPC is maintaining the UK countercyclical buffer at 1%. The FPC continues to assess the risk to disruption of UK financial services arising from Brexit, and we're acting in three principal ways to reduce the impact of these risks on UK households and businesses. First, we're ensuring that the UK banking system could continue to lend to UK households and businesses even in the event of a disorderly cliff-edge Brexit, however unlikely that may be. In particular, in our 2017 stress test, our 2017 stress test encompassed a wide range of UK macroeconomic outcomes that could be associated with Brexit, meaning that Brexit risks do not warrant additional capital buffers for UK banks. And in this regard, it's worth recalling that the capital strength of major UK banks has tripled since 2007, with the aggregate Tier 1 capital ratio of those banks rising to 17% in the first quarter. And it's also worth recalling that the contingent liquidity of those banks has risen tenfold over the same period to more than 100% of short-term liabilities potentially subject to run risk. Second, the FPC has identified the most important risks from a cliff-edge Brexit to the provision of financial services, and we've outlined the necessary steps to address those risks. As detailed in the FPC's updated checklist published today, progress has been made, but material risks remain. At the March EU Council, an implementation period was agreed until the end of 2020, subject to finalization and ratification of the withdrawal agreement between the EU and the UK. The UK Parliament the European Withdrawal Act has received royal assent. The UK government has committed to legislate, if necessary, to put in place a temporary permissions regime to enable EU-based financial companies to continue to provide financial services to UK end users. Once enacted, this will mitigate a number of risks of disruption to UK customers, including those related to insurance contracts. The biggest remaining risks of disruption are in areas where action is needed by both UK and EU authorities, such as ensuring the continuity of the 96 trillion of existing derivative contracts in both the cleared and uncleared markets. Based on our experience and knowledge of these markets, it will not be possible, ahead of March 2019, for private financial institutions on their own to mitigate fully the risks of disruption to financial services. The UK government's temporary permission regime would provide the UK side of the solution. The EU has not yet indicated their solution to these fundamental issues, which would be expected to have more material impacts on the costs and availability of finance on the continent in the unlikely event of a disorderly Brexit. The FPC welcomes the establishment in April of a technical working group chaired by the ECB and the Bank of England on risk management in the area of financial services in the period around the 30th of March 2019. And the third thing that the FPC has done around Brexit is to make clear that irrespective of the particular form of the UK's future relationship with the EU, and consistent with its statutory responsibility, the Committee will remain committed to the implementation of robust prudential standards in the United Kingdom. This will require maintaining a level of resilience that is at least as great as currently planned, which itself exceeds that required by international baseline standards. The FPC is increasingly focusing on operational risks. We announced today that we will set standards on firms' recovery plans following cyber attacks. These standards would be known as impact tolerances. Now, to be clear, firms have primary responsibility for their ability to resist and recover from cyber attacks. But to guide firms in their planning, the FPC will set impact tolerances, specifically the time after which a disruption of vital financial services could cause material economic impact. Firms will be expected to demonstrate their ability to meet the FPC's impact tolerances in severe but plausible scenarios. The FPC will assess this via cyber stress tests developed in coordination with other authorities, including the National Cyber Security Center. If firms can't demonstrate they're able to withstand these tests, remedial action plans will have to be developed and agreed with supervisors. The bank plans to launch a pilot of the approach to operational resilience next year and will publish further details on this in the fourth quarter of this year. These tests build on the FPC's broader cyber strategy, which includes regular penetration testing of over 30 of the largest firms, consistent supervisory follow-up on the key findings of those tests, improved cyber governance within firms, new communications protocols, and robust international coordination arrangements, including through our leadership of the G7 Cyber Expert Group with the U.S. Treasury. To conclude, events of the past few months are a reminder that many of the most important risks to financial stability in the United Kingdom originate beyond our shores. The recent tightening in global financial conditions could be a precursor to a much more substantial snapback in world interest rates and more challenging bank, corporate, and sovereign funding conditions. Rising protectionist sentiment could sap some of the current strength of the global economy and reduce the size of sustainable external imbalances. While UK authorities are putting in place the measures to address financial stability risks that can be dealt with unilaterally, the complete set of mitigants to the risks of a cliff-edge Brexit also rely on the efforts of EU authorities. And cyber risks to UK financial services could originate from anywhere on the planet. The FPC is working to ensure that our system has the necessary resilience to meet the needs of UK households and businesses in good times and bad, whether risks originate at home or abroad. And with that, Sam, John, and I would be pleased to take your questions.
Okay, as always, please give us your name and also the organisation you represent, and we'll keep to one question at a time for the first go round at least. So begin with Kamal and then Chris.
Thank you. Thanks, Gareth. Kamal Ahmed, BBC. Governor, despite many concerns raised by business, is it right that you're saying that actually good progress has been made on preparations for Brexit on the UK side? And are you also warning in contrast the European Union side that they are still lagging?
Well, in terms of financial services, there's been close coordination between UK authorities, the bank, the FCA, and the Treasury. The UK government has, we as the FPC have identified the risks, the principal risks we see to financial stability around Brexit. And of course, we focused in on the most severe scenario, however implausible it may be, given that there is a withdrawal agreement between 28 governments. We focused on a disorderly cliff edge Brexit. We've detailed the risks, we've capitalized the banks to that possibility, and then we've detailed the so-called cross-cutting risks and identified what, in our view, are the types of actions that need to be taken. And with respect to the actions in the UK government has responded. They've signaled a willingness, if necessary, to put in place both a temporary permissions regime for EU 27 financial institutions, actually technically EEA financial institutions, think banks and insurers who are providing financial services here, but also a temporary recognition regime for EU-based financial market infrastructure, think central counterparties that are used by UK financial institutions. So the UK government has responded. It's indicated a willingness to do that. Now with the receipt of royal assent for the EU Withdrawal Act, it has the legal authority to move forward when if it deems necessary. So those things are being put in place. Where there are cross-cutting issues, and derivatives is the most obvious example, where there are cross-cutting issues, it requires action on the European side as well. And as you know, at the end of June 2018, the European side has not yet indicated how it will address those issues. So we have a responsibility to the British public to make clear where things stand. But I will maybe just emphasize something in terms of what the UK government has done, or what they have intended that they're willing to do if necessary, is something that would ensure that, for example, if a UK policyholder had an insurance contract from an European provider, that contract would remain legally valid. It also would mean that a European institution, bank that operates here, would continue to be authorized, subject to the authorization process of the PRA, which Sam can speak to. So we're putting in place the things that looks to have seamless continuity of service, particularly to the UK. We're duty bound to point out where there are still work to be done. We're obviously pleased to be working with the ECB, assessing the risks around the period around the withdrawal date, March of 2019.
Chris Giles from the Financial Times. Governor, the US has imposed tariffs on Europe and China and started what looks like it's going to be a trade war. We don't know how big yet. How vulnerable are British financial institutions to an escalation of tariffs and maybe even financial sanctions that might come from the US and the global financial system? And what action can the bank take to mitigate those risks?
Well, I'll say first, with respect, as the committee looked at issues around protectionism and the concerning developments that have taken place in the last several months, the escalation not just of rhetoric but of potential action and the broadening of potential action, we've looked at the potential economic impacts of those actions if they are put in place. As you can appreciate, the strict mechanical impact of tariffs being put in place, even some of those that have been discussed, is manageable. But the question is the extent to which these measures start to affect business confidence. You have a negative effect on, for example, business investment. And to what extent is it possible, as I alluded to in my opening remarks, that it's one of the potential triggers for a broader risk-off or risk-off attitude or adjustment to risk appetite in financial markets? And those are possibilities, and of course, being a committee whose job is to always look at the glass as being half empty, those are the possibilities we've been looking at in terms of ensuring that the financial institutions here are resilient to it. In that regard, the last several years, irrespective of the trigger, whether it's challenges in an emerging market or trade protectionism, we've been looking at exactly these types of risks. So a sharp snapback in interest rates, a sharp increase in risk premia, and increased risk premia on UK assets specifically, including on bank funding costs. And so as a consequence of that has been to put the banks in a position, not just so that they have the capitalization for that type of scenario, which they do, but also their liquidity positions they're well structured for this type of potential market difficulty. I'll give you a couple figures which are in the report. One is that if you go back 10 years ago, admittedly not a great time, but 10 years ago pre-crisis, about 16% of the balance sheet was funded in the repo market. Now it's 4% of the balance sheet funded in the repo market. As I alluded to in my opening, or said in my opening remarks, they're now in a position, the banks, UK banks are now in a position where they more than cover all of their short-term funding that is potentially, in an extreme scenario, subject to run risks through their own liquid asset buffers or through access to liquidity facilities of the UK. So that helps mitigate the risk. And I think there's one other structural point, if I could, that I think helps mitigate the risk, which is that with respect to financial services, over the last several years and since the new U.S. administration has come into place, we have worked very closely with our U.S. colleagues on the design and the implementation of international standards. And I think there is, obviously can't speak directly for them, but it's my view that there is a shared understanding that we both have implemented these standards and gone beyond those international standards given the importance of our respective financial systems, and that there is a degree of mutual respect and trust in those systems, and a recognition, my last point, that of the value of maintaining openness between those systems. And I think that also helps to mitigate the risk that you're raising. But the fact that you're even raising the risk is indicative of the potential seriousness and some potential knock-on effects of trade discussions, which at present are quite challenging.
Ed and then Ida.
Sky News. Can you characterise, Governor, what would happen if those trillions of pounds worth of derivatives, cross-border derivatives between the UK and Europe, do become unserviceable? Is that something that's small beer, or is that a big deal? And related to that, why is it that the European Banking Authority says that banks aren't ready for a hard Brexit, whereas you say they are?
Well, I think on the latter part of the question, the second part of the question, I think the EBA's, with respect, the EBA's comments earlier this week, or opinion earlier this week, were incomplete, and they were incomplete to the extent to which it did not acknowledge the temporary permissions regime, or potential temporary permission regime, which has been very clearly signaled by the UK government. And now, as I just mentioned, the UK government, literally on the day before they issued that opinion, the Friday before the opinion, with royal assent of the withdrawal bill, the UK government got formal ability to do it. Now, of course, it has to then decide to move forward with it, but certainly the contingencies are there in place. So I think that's a question for. I think it's a question for the EBA first. Why that aspect is incomplete. Second part of important point to your question is that when we looked at the capitalization and liquidity positions of the banks in our stress test in 2017, now we did, as you recall, we did a different stress. It was a global market stress with a big misconduct stress, which had various knock-on effects. But we did look at various channels that a hard Brexit, a disorderly Brexit, not just a hard Brexit, a disorderly cliff-edge Brexit, could affect the UK financial system, including exactly this issue. So what would potentially be the knock-on effects through asset prices, funding conditions, the steepness of yield curves, et cetera, the level of sterling? What could potentially be a range of impacts, and were they encompassed? Was that less than the overall level of that stress involved? And the answer, in our judgment, was very much the case. You could take that shock, which is not a good thing to have, and other shocks, and it would be less than what was admittedly a very severe stress test. But that's why we ran a very severe stress test. I think the important thing to recognize is that these issues can be addressed. We have found with the government what we view as a rock-solid UK-based solution to the UK side of the issue. There may be many different solutions on the EU side of the issue. But if I may just, I'm going to prolong this for a moment because I think it's important that we make it clear that our judgment is that this cannot be solved by the private sector. And maybe if I can just ask Sam to say a word, because we have experience with these type of adjustments, but on a one-off basis, and that informs us just how much can be done in 9 months. And when we're sitting here 9 months from the time when you have tens and tens and tens and tens of trillions of derivatives that mature after the withdrawal date, put it in some context. Sam?
So maybe I can just give you a bit more colour on some of the practicality of that issue and why we think it is simply impractical to think that 29 trillion in uncleared derivatives can be moved across the border in a 9-month period. So just to give you some colour of that based on our experience, first point, you could expect a large UK broker-dealer to have upwards of 4,000 direct clients on the other side of the border. So if we're talking about innovation, that's the sort of number of clients who would need to agree. However, that understates the issue for two reasons. One is that in many cases, the underlying beneficial owner, who will be a client of the client, may also need to give their consent, and you might expect, it's hard to get good numbers for that to be a much larger number, say 20,000 for one broker-dealer. And of course, we're talking about this happening simultaneously across a whole range of institutions in both directions and all of their clients. So that is the kind of logistical challenge. How bad is the problem if it doesn't get done and no fix is put in place? Well, we think that is a real problem. And why is that? It's not the case that a sudden Brexit or disorderly Brexit would sever those contracts. The issue is that to varying degrees in each of the 28 countries, the ability of companies to service those contracts with what we call life cycle events would be impaired because it would be illegal to do that without the authorization. And we're talking about things here like exercising an option or rolling an open position or trade compression. Now, again, there's some definitional issues here, but that is a high volume activity. So to give you one example, for a large UK broker-dealer, we have an estimate from one of them that the number of such life cycle events which they have to engage in per week across equities, credit and rates is close to 300,000. So this is a very high volume of activity which we think will cause a serious problem if not fixed. The last couple of points, Mark says, we've got experience of doing this, moving derivative books across borders in individual cases. We've had that coming into the UK, we've had it going out of the UK. Our experience is 4 years would be a norm for one firm doing that individually. I think you could expect it to be longer where you've got everyone doing it at the same time. The last point to make is, of course, if you don't get clients to novate, you can potentially use the court process, a Part 7 process. Now, that's much more common for insurance business, and with a fair wind, with a completely vanilla type of Part 7 move for an insurer, you could think 18 to 24 months. I think in this context and in the banking context, it's unrealistic to think of that as a timeline. And the particular reason I say that is that we've just been through a whole set of Part 7s for banks, which we call ring-fence transfer schemes, which are just Part 7s in the context of ring-fencing. That's been a 4-year process. So for all of these reasons, we've been saying for a year that we think the authorities have a role for solving the contract continuity issue, and as Mark says, we have that on the UK side, not yet on the EU side.
Okay. Last thing, for those who haven't lived this and don't want to live it, 2 definitions. One, Part 7 is a court process, and novate is a way of taking a contract between 2 parties and changing the other counterparty. So you go from the UK-based bank to the European-based bank, but the other party has to agree, and as Sam says, that goes into tens of thousands, and then in many cases, the counterparty you have has thousands, literally, of underlying clients. They're an asset manager and have underlying clients. So that's why it's complicated. It's unfortunate it's complicated. I'm not sure when the Article 50 was designed with the derivatives market in mind.
Okay, Ida, at the front here, and then Phil.
Hi, my name is Guido Taff. I work for Financial World. Could you put a figure on what a snapback in interest rates would look like? Is it 2%, 4%, 100 basis points?
Well, I mean, first off, to recognize that what we're looking at is not a prediction, it's not a forecast, it's a tail risk environment. When we did our most recent stress test, we were moving base rate from and long rates up by almost 300 and 350 basis points, right? 4%. Yeah, to 4%. So bank rate went to 4%, and then we built in some additional term premia out to on the 10-year gilt. So we have to look at something that's quite extreme. I mean, obviously, it's not a prediction of what's going to happen. I think the important thing to stress on snapback is it's both a, it's a possibility. Certainly, it is a tail risk. It's a pretty readily identifiable and has been identified tail risk for several years, and we should be prepared for it. The last point I'll make is that being prepared for things in a financial stability sense doesn't necessarily mean that the economic outcome is that attractive. It just means that the financial system is dampening the impact of a risk crystallizing. It's dampening, not amplifying it, and of course means that the economy, the financial system is in a position so the economy can pick up and move forward more readily from that point.
Phil Aldrich at the Times. I just want to leave aside the differences between the EU and the UK on Brexit stuff briefly, because there have been reports of differences between the Treasury and the Bank of England on some of the financial services, the deal that we're hoping to strike. So I just wondered if you could clarify whether there are differences and what the positions are, and also are we seeking, is the bank's position still that we're seeking the best outcome is mutual recognition of outcomes?
Yeah. I'll start, and John, you can amplify. But the first thing, state the obvious, is that the negotiation with the EU is for the government to conduct and ultimately for Parliament to approve a final deal. Our job is, apart from everything we've been discussing thus far in terms of risk management, is to provide technical advice as needed to the government, and that's principally through the Treasury. Secondly, in terms of our views, as I indicated in Mansion House last week, and I think consistent with the public statements, the Prime Minister's Florence speech, the Prime Minister's Mansion House speech, the speech of the Chancellor at a large bank's headquarters, I shouldn't necessarily endorse that bank, but recently in Canary Wharf, those are all consistent in terms of focus on, and definitions are somewhat loose in this world, so I'll try and be clear. A mutual recognition that is based on outcome-based equivalence. Obviously, that outcome-based equivalence itself is based on a fairly high degree of alignment in the standards that are applied, a very close degree of supervisory cooperation, but also some form dispute resolution mechanism and adjustment. So those are all consistent. And as I said, we are working we're working closely. We think it's both feasible and in the interests of both sides. But I think, as you also would be aware, that these discussions, at least to my knowledge, these discussions between the UK government and the EU 27 have not really begun on with respect to financial services. The issues that have been in the news around the withdrawal agreement, around goods, around Ireland, a host of other issues have been occupying, quite understandably occupying certainly the lion's share, if not the totality, of the discussions thus far. So it still remains to be seen and engaged. But John, do you want to?
Yeah, I'll just say I don't really recognise that description of the bank-treasury relationship at all. I think a lot of the work we've just set out that we'd be doing with the Treasury on the transition on the legal basis is the product of very close cooperation, and we wouldn't be where we were if we weren't able to do that. And when it comes to the future end state, as the Governor said, negotiations haven't started, but the equivalence of outcome-based supervisory cooperation, deep cross-border relationship set out by the Chancellor and by the Governor seem to me to be very much the same thing. The last thing I'd say is there's a tendency in all of this, as you said, for people to talk about labels and to throw labels around in quite a confusing way. The key thing, I think, for us, for the EU, and for the other countries that we share financial risk with, is to understand what are the risks. What are the risks around this activity that goes cross-border? What is a proportionate and effective way to manage those risks? And just about the whole of the international reform programme after the financial crisis has been about getting agreement cross-border about how we manage those risks, not just between us and the rest of the European Union, but more broadly. So I think when you start to look at this, you have to focus on what's the risk, how do we manage it, what's an effective way to manage it, rather than is this model or that model, if I can put it that way.
Just one along and then Phil. No, sorry, just the lady next to Phil there. That's it.
Anna Isaac from The Telegraph. I wanted to ask about UK external financing, the kindness of strangers issue. It seems to me that in the report there's an increasing sensitivity to the fact that foreign investor appetite for UK assets could fall. How concerned are you about that happening, given that our reliance on it has increased so much in recent years, particularly in the climate of a global trade war and amidst Brexit uncertainty?
Yeah. It's an important issue, and as detailed in the report, subject to the usual caveat around UK statistics in that they tend to get revised, and balance of payment statistics are, particularly prone to revision. But subject to that caveat, broad brush, there has been a shift in how the current account deficit has been financed to foreign inflows in the last few years, as opposed to drawdown of UK assets held abroad, as you picked up, and that those foreign inflows have tended to be in the, again, as detailed in the report, have tended to be in the more volatile camp. In other words, less on foreign direct investment, more in what's called other investments, so more portfolio type moves in, including interbank borrowing, and although I don't think there's a lot of that, to be honest, of interbank, but in shorter-term debt markets and other capital markets and money markets. So more foreign financing in the more volatile end of the spectrum. So what that then means is it puts a premium on the macroeconomic frameworks in the country, which are certainly our view in the case of the Bank of England, very clear. Clear inflation target, clear remit and responsibilities for the FPC. What we're talking about today, the way, as long as we continue to do our job and come clean on where we see the risks, the main risks, what we can do about them, take action, challenged by you, challenged by Parliament, by citizens, on those, there'll be merited confidence in that this system can is resilient to a series of shocks. And I think given some of the shocks that we're contemplating and have contemplated through our stress tests, contemplating through a cliff edge Brexit, that actually has a benefit, if I can, you know, unusually be positive at this press conference, as a benefit in that if you're resilient to those, you will tend to be resilient to other shocks that you haven't anticipated and can't conceptualize, but actually might crystallize while you're focused over there. So that is the good news, and I think as well, last point, if I may, which is that, and again, it's a view of the committee commented in the report that, you know, maintaining the UK's traditional openness to trade investment also is an important component of sustainable financing of the current account. That's not an end in itself, but also to sustainable growth in the economy, and the issue will be maintaining that through a process of leaving the European Union in an environment where protectionist sentiments elsewhere at least appear to be are rising. Having come from the G7, I know they've risen, at least for the moment. I said that was my last point. I'm going to abuse my position and make one last point. I think, though, that the UK is in a strong position to make the case for openness, not just because of its history, but also to end on financial services, because what has been done in financial services to put this system in a much more resilient position, and that allows the country to be confident about keeping this system open and ideally having other systems maintain their openness to ours, not just about Europe, but the US and others, which create opportunities that can offset some of these tensions. Thanks.
Okay, Phil at the front here.
Hi, Philip Inman from The Guardian. I was curious about the working group, Brexit working group with the ECB. How is this going to speed things up in terms of you getting some kind of agreement? Are you meeting regularly? Is this something that you're expecting to produce a document in the near future to help the EU come up with reciprocal arrangements?
Well, first thing, Phil, it's always good to talk, even amongst financial authorities. So we have met, the working group has met a few times. We're not going to provide a running commentary on those, on the specifics of those meetings. The reporting relationship is that the Treasury and the European Commission are members of the working group as observers. And so effectively there's real-time reporting to those authorities who would be, if there were things to communicate directly, would communicate. But it's, as I said at the outset, and the committee says in the report, we very much welcome the formation of this. It's helpful to be addressing the issues. And I wouldn't, just to, if I can amend one bit of your preamble, which is that this is for shared understanding of the risks around March 2019, risks to financial services, to be absolutely clear. So it's a sharing of views, data, perspective, analysis of the risks, and so it's not just us. It's not a monologue. It's a dialogue, as you'd expect.
But we shouldn't be expecting a report to come out.
No, you shouldn't expect a report. You should look. What you should expect from the authorities. I mean, we have reporting requirements with FSRs and reporting department, but you should expect results around issues like this. This is not a term paper.
Okay, one back and then James.
Hi, I'm Dave Goodman, Bloomberg News. Did the new powers granted to the Bank of England last week give you more ammunition to deal with the fallout from a disorderly Brexit? And is that is the new relationship partly a preemptive measure against such an outcome?
The short answer is no. We were in a position, and I'll expand on that. We faced some related issues, perhaps not, certainly not the derivative issues, but potential market move issues around the referendum, or at least we planned for these types of moves around the referendum when we didn't have the additional capital, and we were still in a position, as you may recall, where about 400 billion sterling of collateral had been placed with the Bank of England, which could be realized into more than 250 billion sterling of immediate liquidity for those institutions if required. And we also had swap lines and other foreign currency arrangements in place. So we can still do that. What the new arrangement, financial arrangement, does is it puts our balance sheet on a firm footing, and ability to provide liquidity in normal and extreme times. And we would expect that liquidity demands of the system will go up as the system eventually moves away from the effective lower bound, as you move into a tighter, just the day-to-day liquidity demands, and that one moves away from emergency type liquidity to part of the functioning, regular functioning of markets. But then if you're doing that and then you have a stress scenario, you need to have additional capacity. So the arrangements are important. I think very important, but they're very important for the medium, longer term, and basically having a balance sheet of the Bank of England and a relationship with the Treasury that is consistent with continuing to have the world's leading international financial center.
I just wanted to ask, Governor, if you had a response to the Treasury Committee's criticisms of the FPC's expenses yesterday. I mean, do you think that the expenses regime in place is proportionate and reasonable, and are you worried there's a reputational risk to the bank here?
Well, I think the first thing, it's absolutely right for the Treasury Committee, for court, for you, for others to question our expenses or query our expenses. Is part of the reason why we put them, we disclose them all. We put them all out every quarter for not just me, but the other policy members, senior members of the bank. So that's the first thing. Second is, I think it's important to have the context in which not just the FPC, but the bank as a whole operates, which is, as we've been discussing this morning, this is the world's leading international financial center. It's the most complex financial system in the world. The UK is rightly at the top table, all the top tables, so the G7, the G20, the BIS, the FSB, the ESRB, the Basel Committee, and on. Those are international groupings. Those international groups meet internationally. We can't have all of them meet in London, and so we have to travel to them. And if you take a look at, for example, my expenses, which I'm sure you have, which over the similar period, last 2 years, total 312,000 sterling, so a lot of money, 52 trips. It's to go to those meetings. Now, we're in a position where the bank, myself in many cases, chairs many of those meetings, so we lead these discussions. These discussions are about the regulations that matter, not just for the wholesale, the city type aspects, but also for the regulations and the resilience of the banks and building societies that your readers up and down the country rely on. And it's important that they're right, that they're both resilient, but they're not disproportionate, and they're not meddling, that international rules aren't meddling in our systems, and that's part of what we do when we're there. But again, to go back to look at mine and just put it in context, so 312,000, 52 trips. In that, what I do, and what I'm not surprised it doesn't get reported, but what I do is I also apply where I have reimbursements and including salary to that, so salary from the BIS, which reduces that number down to the equivalent of £3,000 per trip. Now, that's still a lot of money, but it's a consequence of having to go to these various meetings. And again, just put it in context, and I'll finish on this, which is that I spent this past, what was a glorious weekend here. I don't know, because I wasn't here. I was in Basel. John, you were in Basel as well, weren't you? We're in Basel, chairing the FSB, chairing the group of global governors, dealing with issues around cliff edge Brexit, dealing with issues around emerging market risk, future of financial reform, issues that are directly relevant. I was very pleased to be able to get back here late Sunday night so I could come into work on Monday morning. And now it cost money to go there, and it cost money to come back. But that's the reality. What's important is that we're good stewards of those public funds. It's absolutely right for you to raise the issue and for the Treasury Committee, that we have the right processes up through, we have the right policies, the right processes. Mine are signed off by the chair of court, my expenses, for example, and that they're reviewed periodically. And I think, as the incoming chair of court, Brad Fried, indicated yesterday, that he expected that he would take a review of those policies and make sure they're appropriate, and that's exactly right.
Okay, Jason and then Daniel.
Thank you. Jason Douglas from the Wall Street Journal. Just going back to the global picture, could I ask you just a brief question about China, please? I know that China is sort of a perennial worry for the FBC, but I'm just curious if, in the context of what we've seen in asset markets in China this past week, and of course in the context of a potential trade war, whether your concerns around the Chinese economy have intensified. Thank you.
Well, I think you're right in that we have, it has been a concern of the challenges in China have been a concern of the FBC for a number of years. I would say concerns shared by Chinese authorities who have responsibilities for these, recognition that alongside the Chinese miracle and great progress, there are some big imbalances in that economy, freely acknowledged, imbalances between external side, domestic, between industrial and services, and imbalances in the financial sector, particularly of a concern. In all respects, the Chinese authorities have plans that are being not just on the shelf, but are being enacted, and progress is being made. And there's been some progress noted in the report, for example, on some deceleration in total social financing, for example. The new regulatory structure that's been put in place in China is very welcome, and I would say from our interaction with the Chinese authorities, whether it's at international meetings or in China itself or here, has been the seriousness with which they're taking the situation and the priority they're placing on it, and the plans that they are putting in place are reassuring. But it's reassuring from a difficult circumstance, and those circumstances have been made more challenging by the trade talks, as you've indicated. So we'll see the tremendous strengths, but the external environment for emerging economies. China's a special emerging economy, but emerging economies in general has become more difficult, and that trend, unfortunately, may continue for some time.
Dan Hinge, Central Banking. How much have firms improved their cyber defences in recent years, and are there any that you still have doubts about in terms of cyber resilience?
Yeah. Okay, Dan, I'll start and I'll pass to John, but say that there has been progress on the cyber side, and in terms of our overall strategy, where we've seen the most progress is in two respects. One, on governance. I know that sounds like a soft element, but actually having clear responsibility at the senior-most levels for this issue, having board responsibility, having Sam and his colleagues at the PRA having intense focus on these and other operational risks, that has sharpened the mind and brought up the priority list. Something you'd think anyways, but it matters because you need broad coverage, first point. Second is that the penetration testing has been conducted on 34 of the largest financial institutions in the country. First round, many of them are on the second round. We're moving from a sort of centrally designed test to a sort of spot test, what are called CBEST tests, but regular testing by the firms themselves, so bringing in external. And the learnings from that, again, are being, the supervisors are making sure that banks are taking the learnings, the lessons from that, and implementing. All of that process is improving cyber defenses, but it's not sufficient, and it's never, you can never declare victory on this. The issue, and I'm going to pass to John on this, that we've been focused on, certainly in this round as the FPC, is to say, let's just change the question, not how do you prevent, or how strong your cyber defense is, but just assume that you get taken out or aspects get taken out, what do you do? And John, if you want to.
Yeah, say that. I think, as Mark said, we've embedded expectations in firms and they responded to them about the sort of resilience we need to resist cyber attack, to detect it when it happens. But what we're doing now is moving to the next stage, that if there is a successful cyber attack, and this threat evolves all the time, how long can the system be down before it comes back up again? And should that be the same amount of time for different parts of the financial system? And the view we've taken is that the point at which financial instability occurs is different, say, for payment systems than for banks, than for CCPs. So we need to design an impact tolerance to tell the financial sector in your area, the time you can afford to be down, you need to come back up again in a certain time. We're piloting that approach with payment systems over the next year, and then to test whether that particular group of firms, payment firms, CCPs, banks, can actually come back in that time. And to do that, we'll design a stress test. It'll be severe but plausible. The stress test will, for example, corrupt the data that a number of firms are using. The question for them will be, if that happens, where do you go? Do you have alternative sources of data? Can you restore data integrity? How long do you think it will take? We won't actually take out, but I can reassure you, the data. So it's got to be a test of their systems and what they have available. And if they can't bring it back up again within the tolerance, then there's a supervisory sort of discussion then about what they need to do to get there. So that completes the part of the system that says, where could this cause a real threat to financial stability within the financial system? Can we then have expectations for impact tolerance that we can communicate to the firms? Can we test that? Can we back it up? And can we start to have the same sort of progress there that we've seen in the first part of this, which is about resilience?
Okay, we have a little time left, so I will take one from Phil and one from Ida.
Yeah, Phil Aldrich from the Times again. Thank you. There's some warning in the Financial Stability Report about the scale of debt levels in Italy and the links between the sovereign and the banks and the economy. Obviously, these have been shown to be dangerous links to have in the past. So I just wondered, how high a risk do you think there is of a potentially systemic shock coming out of Italy and another sort of mini sovereign Eurozone debt crisis?
Yeah.
Obviously, and how that would affect us, our banks.
Yeah. Well, the first thing on the last part of your question, in terms of direct exposure of the UK financial system to Italy, as I think detailed in the report, it's pretty modest, surprisingly modest. As I think, Sam, it's less than 10% of CET1 of core equity. But Italy is a large, extremely important economy, highly integrated with the rest of the euro area, and as a consequence, if there were severe issues in Italy, one would expect broader challenges in other euro area economies, and quite rightly, there is quite understandably, maybe it's a better way to put it, there's fairly large exposure to the euro area as a whole. So it's hard to escape if there were broader challenges in Europe. That said, what we've seen thus far is that there's been very little contagion from Italy to other euro area economies, at least in financial markets, and that in part reflects the progress that has been made in countries such as Portugal, Spain, others in terms of the core of their banking system, improvements in the competitiveness of their labor markets, reduction in their external imbalances, and improvement in their fiscal positions. So that provides some considerable buffer, if you will, to a rerun of what we had seen in 2011 and 10, and that's before getting to a more explicit policy of the ECB. All that said, what is commonly acknowledged, what's well known, in the words of President Draghi in the Five Presidents report, that the euro is still unfinished business, and the discussions to finish that business, whether it's on the banking union, capital markets union, and ultimately some sort of more formal fiscal arrangement, is arguably in the view of that report, and it's certainly a view I would share, is ultimately necessary to provide a more stable footing.
Ida at the back.
Could I ask two questions? You mentioned that the financial system was strong enough for the UK to create some opportunities to offset external problems. What are those opportunities? What could it do? And how much time does the bank spend dealing with Brexit?
The answer to the second question is a lot, and rightly so, a lot, because the Brexit issue is both one of risk management, as we've been talking about today, and it's also about a potentially, fairly wide range of future relationships and the implications of those relationships, and doing analysis as needed around those. Again, we have nothing to do with any negotiation related to this, but there's just a very large variety and variance of relationships that could be in place, and opportunities and risks that one has to look at in support of a much broader analysis that the government has to do. So we spend a great deal of time on it, and I mean, look, I probably spend 40% of my time. I mean, it's close to half. Is the short answer. Where are the opportunities? But there are big opportunities from the progress that has been made over the last decade. This is a point we really do try to emphasize, in that the G20 reforms have addressed the major fault lines which caused the last crisis. There's a consensus around them through the FSB. They've been agreed. FSB members, which is broader, it includes the G20, broader than G20, are now implementing those reforms. We're now making appropriate adjustments on the margins when the reforms could work better. So that lays the groundwork for an open, resilient system, and the UK at very close to the center of that open, resilient system, and that is an opportunity, and it's very much an opportunity for emerging economies, which was something that we were discussing, or at least it was a monologue because it was a speech, but I was trying to raise last week at Mansion House, which is that there is this shift in global economic weight. There's likely to be a shift in that accompanies it over time in the major reserve currencies, not just conceptually, but in actual fact. London has a natural role intermediating that. That's why a lot of time is spent on renminbi finance, rupee finance. And if you have the underlying financial confidence in the financial system, merited confidence in the financial system, that is a very large opportunity for everybody concerned. I won't belabor it, but there are a host of other opportunities that we look at, given the FPC from a risk perspective, but it's also potentially risk-reducing perspective around fintech, risk to incumbent firms, but risk-reducing in terms of diversity in the system.
Do one last one from Ed?
Sure.
Okay, just next up, and then that'll be the end. Thanks.
It's just kind of a relatively quick one. When it comes to Brexit, how important would you say it is that the governments or media people listen to the concerns of business, whether it's about their order books or indeed about the financial system? Because there are some ministers who have been reported as saying "F business."
Well, it's not a minefield. Look, that's a fundamentally political question for governments to weigh the. That's what governments do. That's what parliamentarians do, which is to listen to and weigh the interests of various stakeholders in the national interests. Our job around Brexit, as the FPC, is to identify the risks, mitigate those risks where we can. And I think as part and parcel of this process, what we've tried to do with the checklist, with these discussions, with speeches, with other things, is to be as clear as we possibly can about what are the main risks, which ones are going from red to green, which ones are still amber or red, so that we're all on the same page in terms of what needs to be done to mitigate it and put the country in the best possible situation, whatever happens in a much, much broader negotiation. Okay.
Okay, thank you very much for coming, everybody.